If you had to choose between dividend ETFs and growth ETFs in 2026, which side wins? That sounds like a simple question, but it is not. Dividend ETFs and growth ETFs are built for different investors, different goals, and different market environments. Dividend ETFs usually attract investors who want income, quality, cash flow, and a little more discipline. Growth ETFs usually attract investors who want capital appreciation, innovation, future earnings growth, and long-term upside. One side may feel safer, the other may feel more exciting, but both can disappoint if you buy them for the wrong reason. Dividend ETFs and growth ETFs can both be smart, but for completely different reasons. So in this video, we are going to compare them side by side, what they are, how they work, examples like SCHD, VYM, VIG, DGRO, VUG, QQQM, and SCHG. When each style may win, the risks most investors ignore, and how to combine both without turning your portfolio into a messy pile of overlapping ETFs. Let's start with dividend ETFs. Dividend ETFs are funds that focus on companies that pay dividends, but not every dividend ETF is built the same way. Some focus on high dividend yield, some focus on dividend growth, some focus on business quality, some focus on companies with a long history of paying or increasing dividends. That difference matters. A dividend ETF is not just a pile of income. It is a strategy for selecting companies. For example, one dividend ETF might prioritize companies with higher current yields. Another might prioritize companies that have consistently increased dividends. Another might screen for profitability, balance sheet quality, or payout sustainability. That means dividend ETFs can be useful for investors who want cash flow and discipline. But dividends are not guaranteed. Companies can reduce them. Growth can slow, and the high yield can sometimes be a warning sign. A dividend ETF is not just income, it is a strategy for selecting companies. Now let's look at the other side of the comparison, growth ETFs. Growth ETFs focus on companies expected to grow faster than the broader market. These companies often reinvest more cash back into the business instead of paying large dividends. That is why growth ETFs usually have lower current income. They are designed more for capital appreciation. Growth ETFs often have exposure to technology, communication services, consumer discretionary companies, software, semiconductors, innovation, and future earnings. Examples include VUG, SCHG, QQQM, and QQQ. But growth does not mean guaranteed returns. That is one of the biggest mistakes investors make. A growth ETF can own excellent companies and still perform poorly if the price is too high. The whole idea depends on future earnings eventually justifying today's valuation. So, a growth ETF is not just a bet on great businesses. It is a bet that future earnings will justify today's price. And that creates a very different investment profile than dividend ETFs. The simplest way to compare these two styles is income versus appreciation. Dividend ETFs usually focus more on cash flow. They may own more mature companies. They may rely less on investors paying higher future multiples, and they can appeal to investors who want income along the way. Growth ETFs are different. They focus more on capital appreciation. They depend more on future earnings growth. They often require a longer time horizon, and they can be more sensitive to changes in investor expectations. Dividend ETFs pay you along the way. Growth ETFs ask you to wait for the future. That does not mean one is automatically better. It means the investor needs to know what they are trying to achieve. Are you trying to build income? Are you trying to maximize long-term capital growth? Are you trying to reduce volatility? Or are you trying to balance multiple goals? To make this practical, let's look at a few real ETF examples, starting with SCHD. One of the most popular dividend ETF examples is SCHD, the Schwab U.S. Dividend Equity ETF. SCHD has an expense ratio of 0.060%. It is popular because it tries to combine dividend income with business quality. That combination is important. Many investors do not just want the highest yield.
They want income that is supported by stronger businesses. SCHD can play that role for investors who want U.S. dividend exposure with a quality-oriented framework. But it still has risks. It can have sector concentration. It can lag during technology-led bull markets. Its dividend payments can change. And it is not risk-free just because it is a dividend ETF. That is the point. SCHD can be a strong dividend ETF, but it is still an equity fund. It can fall, it can underperform, and investors still need to understand what it owns. SCHD is popular because it tries to combine dividend income with business quality. But SCHD is not the only dividend ETF style. So let's compare VYM, VIG, and DGRO.
VYM, VIG, and DGRO show why dividend ETFs are not all the same. VYM is the Vanguard High Dividend Yield ETF. It has an expense ratio of 0.04% and a 30-day SEC yield of 2.25% in the latest data checked. Its role is more focused on higher dividend yield. VIG is the Vanguard Dividend Appreciation ETF. It also has an expense ratio of 0.04%, and its 30-day SEC yield was 1.52%. But VIG is more focused on dividend appreciation and dividend growth quality. DGRO is the iShares Core Dividend Growth ETF. It has an expense ratio of 0.08% and a 30-day SEC yield of 1.98%. So the difference is not just the yield number. The difference is the strategy. VYM is more yield-focused. VIG is more dividend appreciation-focused. DGRO is more dividend growth-oriented. Not all dividend ETFs are built for the same kind of dividend investor. Now let's cross over to the growth side and start with VUG. A major example on the growth side is VUG, the Vanguard Growth ETF. VUG is built for investors who want broad U.S. growth exposure. Its expense ratio was reduced to 0.03% in 2026, which makes it extremely low cost for a growth ETF. But unlike a dividend-focused ETF, VUG is not designed primarily to pay income. It is designed for long-term capital growth. That means investors should expect lower current yield and more dependence on future earnings growth. VUG can be attractive for investors who want exposure to large-cap growth companies and long-term compounding. But the risks are real. Valuation matters. Mega-cap concentration can matter. Interest rates can matter. And drawdowns can be sharp when growth stocks fall out of favor. VUG is not built to pay you now. It is built for long-term growth exposure. But VUG is not the only growth ETF investors compare. So next, let's look at QQQM and SCHG. QQQM and SCHG are both growth-oriented, but they are not the same. QQQM is the Invesco NASDAQ 100 ETF. It has a total expense ratio of 0.15%. It gives exposure to the NASDAQ 100, which often creates a strong growth and technology tilt. That can be powerful when large growth companies are leading the market, but it can also create concentration risk. SCHG is the Schwab U.S. Large Cap Growth ETF. It has an expense ratio of 0.040%. It offers U.S. large cap growth exposure, but through a different index and methodology than QQQM. That is the key lesson. Growth ETFs can look similar from the outside, but the index behind the ETF changes the risk. One fund may be more concentrated, another may be broader. One may have more technology exposure. Another may define growth differently. Growth ETFs can look similar, but the index behind the ETF changes the risk. Now that we have examples on both sides, let's talk about when dividend ETFs may actually win. Dividend ETFs may shine when investors care more about cash flow than promises. That can happen in more defensive markets. It can happen when growth valuations are under pressure. It can happen when interest rates are still relevant and investors want more visible income. It can also happen when the market starts rewarding mature businesses, profitability, dividends, and balance sheet quality. Dividend ETFs can also help investors psychologically. Cash flow can create discipline. Income can make it easier to stay invested. And dividend-oriented companies may be less dependent on aggressive future growth assumptions. But dividend ETFs are not guaranteed to outperform in those environments. They may simply fit certain investors better, especially investors who want income, quality, and a strategy that feels less speculative. Dividend ETFs may shine when investors care more about cash flow than promises, but when the market starts paying aggressively for future earnings, growth ETFs can take the lead. Growth ETFs may win when the market is willing to pay for the future. That can happen when interest rates fall, when risk appetite improves, when earnings growth is strong, and when technology leadership is driving the market. In 2026, investors are still watching themes like artificial intelligence, software, semiconductors, automation, and innovation. Those themes can support growth ETFs if the earnings actually follow through. Growth ETFs can offer more upside when the market rewards companies that are expanding faster, but there is a trade-off. Growth ETFs can be more volatile, they can be more expensive, and they can fall hard when expectations reset. The same feature that creates upside can also create downside. Growth ETFs may win when the market is willing to pay for the future. But before choosing a side, this is a good moment to pause and connect the strategy back to the channel. This is the kind of ETF analysis we focus on at Boring Money Wins, not just asking which ETF went up the most recently, not just chasing yield, not just chasing technology, and not pretending that one style is perfect for everyone. The goal is to compare income, growth, risk, valuation, taxes, and portfolio fit. If you like no-hype ETF analysis that explains both the upside and the downside, hit the like button and subscribe to the channel. It helps the channel grow, and it tells YouTube to show more practical investing content to people who want long-term investing without the noise. Now let's talk about the risks, because both dividend ETFs and growth ETFs can disappoint investors who misunderstand what they own. Dividend ETFs have risks that many investors underestimate. The first risk is the high-yield trap. A higher yield can look attractive, but sometimes it reflects a weaker business or a stock price that has fallen for a reason. The second risk is that dividends are not guaranteed. Companies can cut them, freeze them, or grow them more slowly than expected. The third risk is less exposure to growth. If the market is being led by fast-growing technology companies, a dividend ETF may lag. Dividend ETFs can also be concentrated in more mature sectors. That can be useful for income, but it can limit growth. There is also total return risk. Getting paid dividends does not automatically mean the total investment return will be strong. And in taxable accounts, dividend income can create tax drag. Income does not replace analysis. A high yield is only useful if the business can support it, and growth ETFs have a different set of risks that can be just as important. Growth ETFs can also disappoint investors. The first risk is valuation. If investors pay too much for expected future growth, returns can suffer. The second risk is concentration. Many growth ETFs are heavily exposed to mega-cap technology companies. That can work beautifully when those companies lead the market, but it can hurt when leadership changes. Growth ETFs can also be sensitive to interest rates. Higher rates can put pressure on long-duration growth stocks because more of their value depends on future earnings. Then there is drawdown risk. Growth ETFs can fall sharply when expectations reset. And there is overlap risk. Many investors already own VOO, VTI, or QQQ. Adding another growth ETF may not add diversification. It may just increase exposure to the same large companies. The growth story can be right, and the ETF can still disappoint. So the answer may not be dividend or growth. It may be learning how to combine them properly. Many investors do not need to choose only one side. They can combine dividend ETFs and growth ETFs in a structured way. One approach is a broad market ETF as the core, with a dividend tilt and a growth tilt around it. Another approach is using dividend ETFs for income and quality while using growth ETFs for long-term appreciation. A more income-focused investor may lean more toward dividend ETFs. A more aggressive investor with a longer time horizon may lean more toward growth ETFs. A balanced investor may use both. The key is to know what each ETF is doing. Do not add ETFs just to add more tickers. Check overlap, avoid ETF clutter, and rebalance periodically so the portfolio does not drift too far from the original plan. The best answer may not be dividend or growth. It may be knowing how much of each you actually need. Now let's bring everything together into the final verdict. So, which wins in 2026? Dividend ETFs or growth ETFs? The honest answer is that both can win, but for different investors and in different market environments. Dividend ETFs may win for investors who want income, discipline, quality, and cash flow. Growth ETFs may win for investors who want capital appreciation, innovation exposure, future earnings growth, and long-term upside. But neither style is automatically better. The right answer depends on your objective: time horizon, taxes, risk tolerance, valuation discipline, and ability to stay invested when your side is out of favor. For many investors, combining both may be more practical than choosing one extreme. Dividend ETFs can pay you today. Growth ETFs can build for tomorrow. The real winner is the strategy you can actually hold. And boring money usually wins because boring money usually survives.